Great. So over the last couple of weeks, we have been flooded with a lot of questions about, how do markets look? Is there any more correction expected? Valuations look stretched. What is it that a long-term investor should be doing at this point of time? So many questions around the health of the market, the valuation, global markets, geopolitical crisis, political scene in India, many questions. So we decided that let's do one session which will focus on data-backed approach on how actually market looks like. So we plan to cut out the noise and focus on what the data tells us. And today for this session, joining me, I have Chartered Accountant Pawan Bharadia. He is having more than 25 years of investing experience. He was working in firms like Morgan Stanley and ABN AMRO Bank. Since 2012, he runs a portfolio management services and that has delivered a CAGR return of more than 32%. And in the last 5 years, they've been in the top five portfolio management services. So 1 crore, if anybody would have invested with them in 2020, with the kind of CAGR which I talked to you about, 1 crore would have been 8.5 crores now. So that is a phenomenal track record which Pavanji has. And today we'll understand that if we cut out the noise, what does data tell us about market? So just, I'm sure a lot of you all know already about what we do at Finovate. We are SEBI registered investment advisors, and we focus on financial life planning. Our overall approach is based on 6 pillars of personal finance, and more than 3,000 professionals, they believe in the process. So we say that outcome or the result, is as good as a process. So what Finovate does is we focus on the process, and a good like your clarity on financial goals backed with a good process will eventually lead you to wealth creation or financial freedom. And that is what we focus on in Finovate, and a lot of people have trusted us with their hard-earned money over the last decade and a half. So once again, welcome to you all, and with this we'll kickstart today's webinar. um, so just to, like I already told that there was a lot of anxiety which people had around valuation. Is this the right time to put money? December's, would FIIs sell and exit the markets? What's going to happen now that Trump is coming in? What about the geopolitical crisis which is there? What about China getting a rating upwards and a lot of money moving to China? What about the massive FII selling which we've witnessed in the last 6 months? So there were many such questions, and always people wanted to know that is this the right time to invest? Or if we have already made investments, is this the right time to add to that investments? And in case if we are already invested and if there is a pullback in the market, should we exit? So these are the kind of questions which we have been getting in the last 6 months very actively. And to address that today, we will be focusing this session on practical data as to on ground, what data do we see? And we'll also be taking a lot of questions. So y'all can post your questions in Q&A. Even while we are talking, it will be interactive. So we will pause, ask questions to Pavanji. And even towards the end, we'll try and take a lot of questions. So with this, welcome Pavanji, and we'll kickstart today's webinar.
Thanks, Nehal. Good evening, everyone on the webinar. This is Pawan Bharadia. I represent Equity Capital. Should we just straight get on to the presentation? Okay, let's start beginning with where we are in the market today. So the last couple of weeks, market has seen a pretty decent fall. In fact, over the last 2 months, market has fallen almost about 11%. And since then, it has recovered a little bit. So now it is close to about 8% down from its peak that we saw on 26/9/2024. So while the index looks only about 7-8% down, but the real story is actually when you reflect on the broad base of the market. Can we move ahead? So this is where, if you see, 33% of the large caps have actually fallen by more than 20%. When I say large cap, this is the top 100 companies. Mid caps are the next 150 companies. So 42% of them are down by more than 20%. And the rest, everything else is small cap. We've restricted small cap companies to the extent of companies which is about 200 crore market cap and not really going beyond that. There, the scenario is far more different. So this genre of companies, 65% of these companies have corrected by more than 20%. And this is where largely people have started feeling that, are we getting into the bear cycle? Because technically more than 20% correction is what is called as a bear market cycle. Can you move to the next, please? So this is where it is. This is a question that is running into everybody's mind. Like what Nehal mentioned, I'm sure everybody is thinking that with that kind of broad-based correction in the market, is it a beginning of a bear market, or does this continue to just be a bull market correction and we may see stocks coming back again very, very rapidly? ये सबके मन में चलता है कि इस तरह के करेक्शन के बाद में इस बाजार में पैसा डालना चाहिए या होल्ड करना चाहिए या क्या करें. That is what we're trying to address with this thing, with some data. So let's look at this and what does the market reward? Typically, there are only three things. It is only growth, liquidity, and valuations. Market looks at companies which are growing. Liquidity represents the sentiments, and valuation represents the pricing or the value from which one could look to possibly create wealth. So these are the only three holy grails so far as the market is concerned. And let's get into each of these to understand that how we are in respect of each of these things. Let's talk about the growth first. So this is non-negotiable. I'm just using some clips from some of the Hindi movies because this is how it is. So like Johnny Lever talks about paisa kidhar hai, from investors' perspective, we look for growth kahan hai. And amidst a lot of media noise, which talks about slowdown across different kind of sectors, exports slowing down, some part of private capex not picking up as well, or the government capex slowing down a little bit in the first quarter. But this is what we see when we look at numbers. So if I look at the first half is just got done, and if I compare first half of current year to first half of last year, these are some of the segments where we have seen decent amount of growth. If you look at automobiles growing at 14%, capital goods 26%, chemicals has been languishing at about 8%. Consumer durables, interestingly, has shown 72% growth. Healthcare, 31% growth. Infra ancillaries, 24% growth. IT, 11%. Retailing and textile growing at more than 50%. So amidst all the things that we hear, but if you look deep down across sectors, you will find that there are enough and more number of companies which have been reporting phenomenal growth so far as the first half is concerned.
I
And
think a lot of time we get these questions about which sector is doing good or about sectoral investments. I think this data very nicely shows that while we should not generalize always in market, there are a lot of pockets even in the current environment which have shown like growth in terms of their earnings from last year. And certain sectors, it's a very, very high double-digit growth.
correct. So what is driving this growth in most of these sectors? There are primarily only three things to the way we are looking at this thing. One is the government spending, which is the larger infrastructure spending, which continues at a breakneck pace. And that's where all of these infra ancillary companies across the board have been seeing a lot of traction. Likewise, import substitution is a very, very big theme which is playing out, where government has been promoting manufacturing to be done in India. So, for example, we all of us know that we were net importers of mobile phones, but today we have become net exporters of mobile phones. So, in segments like these, in segments like defense, India again has moved up from being a net importer of defense to becoming an exporter of defense. So, those are the kind of things that we have been seeing. Can you move ahead, please? So if I were to cut this thing across different genres in the market, and that's how investors look at, large cap, mid cap, and small cap, the growth actually has been in the small cap segment, which is growing at almost about 23%, whereas the large caps have been languishing at about negative 5%, and mid caps have just been about stagnant at minus 1%. So clearly, small cap seems to be the genre where the growth has been coming about. And from an investor's perspective, if one is looking to chase growth, then this is a segment that one should be looking forward.
Yeah,
Let's move ahead and understand
yeah,
that.
I think this is very interesting that first half of FY25, the earnings of large cap have been negative as compared to the previous years because
Correct.
that's what a lot of noise is going on, that earnings are not good. So I think instead of broadly generalizing that corporate earnings are not good, it's a very good data to see where the corporate earnings are not good. And I guess right now it's very obvious that large caps or the top 100 companies is where there is a degrowth in earnings the first half of this year as compared to last year. Whereas
Correct.
mid caps also it is flat, and surprisingly it is small cap where the earnings have grown a lot as compared to the first half of last year. So
Correct.
very surprising data, because when markets are so volatile, people expect small caps to do very badly. And people expect that small caps is just a valuation game and there is no actual real earnings growth, or, it's not driven by earnings, but it's driven more by liquidity and more by sentiments, or, more by just news and tips and all that. But the data here tells a completely different story.
Correct. And let's delve into why small caps have been seeing this kind of a growth, and I think that will answer a lot of questions that will be there in the people's mind otherwise. If you could just move ahead, please. So, like I mentioned, there are only three things, right? Import substitution, export opportunities, and infra spending, which has been driving. Now, again, if you go by the headlines, you will possibly read that export is slowing down. We again deep dived, and interestingly, what we realize is some of these segments, electronic goods, engineering goods, organic and inorganic chemicals, defense, has been growing at 38% CAGR for the last 3 years. Auto components have been growing at 17% for the last 3 years. And what is the reason for this thing? It's basically some bit of China plus one playing out, some bit of Europe plus one playing out, because post the Ukraine war, European manufacturing has practically collapsed. And that is enabling a lot of Indian manufacturers and engineering companies to cater to these segments. Now, with this kind of CAGR, and largely these are all segments which relate to your manufacturing and engineering goods. Can you move ahead, please? And where do you find all of this manufacturing? So again, interestingly, Nifty 50, which is the representative of the large cap, has only 18% representation from manufacturing and engineering segment. Whereas if you go to the micro cap segment, and I'm here distinguishing between micro cap and small cap, because micro cap is the segment where the average market cap is close to about 6,000 crores. And if you look at the Nifty small cap 100 index, there the average market cap is close to about 16,000 odd crores, and then upwards of that. So if you look at the Nifty microcap segment of 250 index, 44% comprises of manufacturing. And that is where it explains this kind of growth that we are talking about. And in the first half, 23% growth that we saw in the small cap, which comprises of companies from 200 crores to going up to almost about 70,000 crores. That's the combination or the structure of companies in manufacturing, which is where growth is getting derived from. Can we move ahead? Now let's move to liquidity. Again, the general perception has been that FIIs have been very heavy sellers. More particularly in the month of October, we've seen selling almost to the extent of almost about a lakh crores, or slightly more actually. If we look at last 3 years, this is how the picture looks like, where FIIs have been net sellers in the last 3 years on a consistent basis. And look at the numbers, they're very staggering. 2,78,000 crores getting sold in 2022, about 16,000 crores in about 23, and current year we already have about 2,69,000 crore worth of goods being sold, stocks being sold. However, this is only one part of the picture. When you look at FII in its entirety, which is the FDI and the FII put together, that again presents a very interesting scenario, where 2022 we did see a negative, almost about 1,25,000 crores, but 2023 saw a staggering 1,76,000 crore positive, which means that the FDI inflows have been very, very strong. And when you have FDI inflows, this is the long-term capital which is coming into the country. And when you have the long-term capital coming into the country, and you see or you read about the FII selling in the market, that's the short-term hot money which keeps moving from emerging markets to developed markets and so on and so forth. Wherever people find opportunity, it will come. The interesting part is, from a global investment perspective, if 1,76,000 crore is coming into India on a net basis after adjusting for the sales, that talks about the Indian opportunity and how people are looking at India and committing significant amount of capital. Can we go ahead, please? Coupled with this, of course, the DII current mood is, going back to the what Pushpa said, "Main jhunkuga nahi." For the last 3 years, people have been talking about the SIP inflows taking pause, slowing down for multiple reasons, but that only keeps increasing. If you look at both the SIP and the lump sum amounts put together, the net equity inflow has been consistently rising. And this year, interestingly, is up till October, it's been 2,45,000 crores. Now, that's the power, newfound power that the DIIs have been exhibiting primarily on bank of the SIP inflows, which is consistently coming into the markets and has not seen any pause despite the Ukraine war happening, despite multiple events which has happened in the last about 3 years' time. And it still continues. I mean, in fact, even last month, FII SIP inflows was almost again at an all-time high, touching almost about 25,000 crores. So
Yeah,
there's
and
no stopping at that.
yeah, no stopping at that. And just till October, we've very clearly surpassed the numbers of previous three financial years, and with still 5 months more to go. And we handle a lot of people's money who are out here, and mostly the mass affluent. So much
Correct.
money people are holding on to cash, waiting
Correct.
for a correction to invest. So
Correct.
I'm just wondering what this number is going to be till March,
Yeah.
because so much is already invested, with so much more waiting in terms of cash to be invested.
Correct. So clearly, liquidity is here to stay, and we don't see this thing slowing down or falling off the cliff in a hurry, because investors have also far more mature today. They understand that market may go through volatility and cycles, but if one is investing with a 3 to 5 year perspective, there is a lot of money to be made in the markets. So the second factor, liquidity, also seems to be fairly robust. Let's move on to the next one. Now let's look at the valuations, because this is again one of the most important factor. This is how today the index looks like on the trailing 12-month PE. And if I were to compare this thing with the 10-year median, possibly you will see that Nifty 50, BSE 500, most of them are actually trading below the 10-year median. When you have the headline indices trading below the 10-year median, uh, generally people would not perceive this thing to be risky point in time to commit capital. Because if you are trading at below 10-year median, 10-year median is a fairly decent long-term uh, track record that one is looking at. And if you go by the headline indices, we seem to be in a very, very comfortable situation. Then what is leading the market for this kind of a correction? Again, the thing is, if you look deeper into the numbers, that's where we'll reveal that why we are seeing this kind of a correction. Can we move ahead, please? This is how it shows. So the indices include the BFSI segment, where typically the P multiples are on the lower side because the valuation framework is very different, and that distorts the headline index. And which is why on an overall basis, you see Nifty or a BSE 500 or a midcap 150 falling only about 8 or 9%, whereas the broad base of the market is corrected by more than 20%. And this explains the reason why. So if you look at the large cap TTM multiples or mid cap or small cap or micro cap, they are all far exceeding the 10-year median and trading at a significant premium. 64%, 38%, 58%. Again, micro cap, which is the genre between 200 crore to 5,000 crore market cap, is at the lowest premium to its 10-year median, which is at 45%. Now, one could argue that this is TTMPE, which factors in earnings only till the first half. And from the commentaries that have been coming from the corporates, second half is likely to be far more better in terms of growth. And next year also is looking reasonably good. So if one were to extrapolate these numbers on a 1 year forward basis, if I were to take March 26 as the base and do this comparison, we would generally be closer to the 10-year median or maybe slight premium to the 10-year median, which again presents a reasonably comfortable place to be in so far as valuation is concerned. And if one were to further dig this deeper, uh, almost about 1/4 of the companies across these market caps actually trades below its 10-year median. Now, from an investor's perspective, if one were to invest time and identify these companies which are trading below their 10-year median, and mind you, there's a fairly large number of companies. So if you look at the small and the micro cap companies, both of them put together are close to about 1,700 companies. And out of that, about 400 plus companies are trading below their 10-year median. Not necessarily everything is investable, but if you have that kind of a large pool of companies to pick and choose from, I'm sure that one can definitely come up with a portfolio of 15, 20 high quality businesses which are growing at a reasonable rate and are still trading at below their 10-year median. And that's where the holy grail of investing actually lies.
But Pavanji, if we remove the banking and financial services, then on a 10-year basis, valuations do look stretched if we look at, say, mid cap or even for that matter, large cap.
Correct. That's what I just explained, right? If you look at the TTMP, yes, it does look quite expensive. But what is not factored in the TTMP is the second half of the current year for that matter, right? Where corporates have been talking that second half is likely to be significantly better than the first half.
Okay.
If you look at the first half, the growth in micro cap, small cap was 23%. And from the commentary that has been coming from corporates, it's likely to continue in the second half as well or get better. Even the large cap companies are talking of achieving some growth in the second half. So if that growth comes about, then your TTM valuation itself will change to some extent. And the business visibility that we're talking about from a next year perspective, even if one were to factor in barely a 12% kind of a growth, this premium will come down to maybe about 20-25% premium, which is in a reasonable range because, uh, 10-year median when one is looking at also brings in a bit of an anomaly in the sense that companies, their base, which it was 10 years back and what it could be today, can be dramatically different. So some premium can be there if the growth is there. I think the crux for investors to look for is whether the growth continues or no. If the growth falls from the cliff, then possibly the scenario can be far, far more different. But if the growth continues, then this premium valuation can possibly sustain itself.
This also draws to the fact that banking and financial services, looks at a fairly attractive valuation right now. Like while the broad market has gone up, but the BFSI segment, if I analyze the data, that when you take the BFSI out, and with BFSI, the valuations look pretty
Correct.
reasonable. So this draws to the fact that these companies, like the banks or other financial institutions, look a little attractive on valuations right now.
Prima facie, yes, Nehal, but there the valuation matrix is anyways generally not looking at the PE, but there
P
are
multiples, yes, price
multiple
to
other
book. Yeah,
valuation matrices to look at BFSI, right? So yes, they do look interesting. But having said that, again, one needs to do a ground up analysis and see where the value is.
right.
How do they trade on a price to book basis or so on and so forth. So there are multiple other valuation parameters that one needs to look at when you're looking at BFSI.
Yes, yes.
But the interesting part is that one fourth of the market across these market caps still trade at a valuation which is below its 10-year median. And these companies still exhibit growth of 20% plus, compounding at a 20% plus. Now that's where investor needs to nibble and find maybe about 10 or 15 businesses that one can invest into. And if you're just invested into a company which compounds at 20%, that itself can possibly give you a 8x or a 10x return in 10-year basis.
Right.
So that's how it turns out to be.
So basically, the worry which everyone had that no bubble is getting created, like, the whole thing that is this just a liquidity driven rally? Because a lot of money is coming in. So is there a scenario of a bubble getting created? But
Mhm.
what we are understanding that also the earnings are, catching up, and there is visibility of growth, which we can see in most of the companies. So investors should not really worry about this just being a liquidity driven rally or a bubble kind of a scenario. If I read the minds of investors better, because this is the most worry which people have at this point of time.
I'll put it this way that it may not be prudent to generalize, the bubble theory or the liquidity theory pushing the prices up. Yes, indeed, in certain pockets, valuations are obnoxious. We see companies trading at 70, 80, 100 P multiples, especially in the SME exchange, some of the IPOs which happened in the last couple of years, and stocks have went up like 3x, 5x, 10x, 30x, 100x without having adequate numbers. So there are certain pockets where this froth is indeed there, but there is enough and more opportunities as well in the market. The sense that I would possibly leave the investors with is that this is a market now which one needs to look at on a ground up basis rather than looking at generalizing by the headline indices or by the headline valuation numbers that one reads into. So while we're talking about all of the factors which drive the markets, let's also understand that what are the key challenges that one is looking at. So clearly, for the election reasons and otherwise, the spending in the first half has been little slow and little tepid, which has led to marginal reduction in the GDP forecast from 7 to 6.8%. So one of the key things to look forward to is the government capital expenditure and whether it really takes off in the second half or no, because that's been doing the heavy lifting for the last couple of years and potentially will remain so for the next couple of years till the private capex picks up. So any reduction in that thing is may lead to the earnings growth slowing down and so on and so forth. Tepid urban demand. Now there again, it's been little contrasting because if you go back and you see, we spoke about consumer durables being one of the highest growth grosses in terms of first half numbers, but yet we keep reading about the urban demand has been tepid. Interestingly, urban demand has been showing a K-shaped kind of a recovery or a scenario where there is too much of consumption happening on the luxury items, but not as much on the mass production and the masses and so on and so forth. So there the signs are very mixed. Again, one needs to look up ground up in terms of which businesses and which segments one is looking at. And there are certain pockets which look very, very attractive and some which are languishing. So you need to pick and choose from where it is. Credit slowdown, this has been part of a concern. But again, one needs to understand how this is playing out, because on one side, we have the corporate India, which is on the lowest leverage balance sheet as of now. But the gross block in corporate India has actually more than doubled up in the last 7 years. So a large part of this capex is actually being driven by internal accruals and equity, as against taking leverage, which is how the capex used to be done in the earlier years.
I
The
think that
credit has
previous slide which you said that the FII money is getting converted to FDI. So
correct,
instead of corporates borrowing from banks, they are getting equity in form of FDIs. So in the long run, that scenario is like healthy for us because this is very sticky long-term money coming in.
correct. So this is how it pans out. That when you look at the headline indices, they give you certain narratives and certain context. But when you look slides down information slightly deeper, and you learn the context, and that's where the whole thing starts changing. Can we move ahead, please? Some of the global factors that everybody has been talking about. I mean, just about a fortnight back, we were all concerned about the US elections and who comes in and what happens. So part of the FII selling was tagged to the uncertainty in the US elections. Russia-Ukraine war has been going on for the last 1,000 days now. It's almost 1,000 days. And we keep hearing, someday blow hot, blow cold kind of a thing. Yet to see where does this settle down and how does this take shape. Global slowdown again is something that for the last 3 years people have been talking about, which indeed is there. So if you look at Europe, there the slowdown is far more evitable. People have been talking about a US slowdown, which has not happened in the last 3 years, and hopefully it will not be there. Looking at the current data, so these are things which possibly will keep going on uh, and at any point in time. I mean, today it was US elections, Russia Ukraine war, global slowdown. Tomorrow it could be China Taiwan. We had Iran also coming up. Hopefully that is also settling down. So these kind of global issues will keep cropping up every now and then. The good part is that India per se has barely about 3% contribution in the global merchandise trade. So what happens in the global scenario, if you look at again the COVID times, India was the least impacted because our supply chains are not as much dependent on the global economics. We are reasonably self-sufficient, so we could recover much faster post-COVID than most other economies. You look at Russia-Ukraine war, some of the East European countries, Latin American companies, they went hungry because even something like food grain couldn't be exported from Russia and Ukraine to these countries which were dependent on them. But we did, excuse me, India didn't face those kind of supply chain issues. So generally speaking, India has been little insulated from these kind of global upheavals. Yes, intermittently they do impact the sentiments and the market momentum from that perspective, but over a shorter term period, over a 6 month or a 1 year period, these things have not really had too much of impact so far as India is concerned. And neither do we foresee that. One thing, of course, which impacts India directly is what happens on the crude, because we still are dependent on the crude imports, and that really hits India very badly. Fortunately, over there also, crude has been fairly stable. The government's position to import oil from Russia at a cheaper price has done a lot of good to India from that perspective. So India has been wielding its own strength in the global arena and has been far less impacted. So again, our thing to the investor has been that yes, while one needs to keep abreast about what's happening on a global scale and the impact that India can potentially have from those things, But these are things which will just keep happening every now and then. So one needs to just take that in your stride and move on. That's the way we look at most of these things. Can we go ahead, please? So, like I said, having said that, India has long-term structural tailwinds in its favor. Uh, India has one of the most stable government. After 10 years, we have again the same government for the next 5 years. Europe, if you look at UK, 3 prime ministers got changed in a span of 6 months. I mean, that's the kind of thing that we have over there. You look at the neighboring countries like Sri Lanka, Bangladesh, Pakistan, all of them have been having some of the other political instability and so on and so forth. Or there are these small skirmishes going on, whether it is Middle East, whether it is Russia Ukraine thing going on. But from India's perspective, India has been fairly stable so far as the government is concerned, and there's increasing spending happening and focus on manufacturing, employment creation, doing all the right stuff as what the government should be doing. Favorable demographic dividend. India again has always had this thing, but this is actually now coming more to the fore because today current age in India is just about 28 years, which is the youngest age in the world. China is at about 38, Japan is at about 41, and so on and so forth. So we are the youngest population in the whole world. So from a consumption perspective, even from the working population perspective, India's working population has been growing at 1%, close to about 1%. So we will possibly end up having 25% of the global workforce in India. Now, that's huge in terms of its magnitude. You imagine 1/4 of the working population of the world will be residing in India. So you can think what can happen to the manufacturing and engineering sectors and so on and so forth that we're talking about. And that also drives a large consumption basket. In fact, even per capita income has been consistently increasing for the last almost about 4 or 5 years. From a low of about $2,000, today we are at close to about $2,600 in a span of about 3 or 4 years. So all of these factors put together are providing that long-term structural tailwinds for India. And we believe that India is indeed at an inflection point for the next 5 to 7 years perspective. And probably we should see what happened in China in the last decade or so should happen to India in the next decade or so. These are again some of the statistics talking about capital expenditure and how consistently this has been increasing. Or the working excuse me, or the working population and the demographics thing that I just spoke about. So from our perspective, I think India looks to be sitting very comfortable at an inflection point from the next 5, 7, 10-year perspective. And if one can ignore the short-term momentum or the corrections in the market, I think there will be significant wealth creation opportunities coming up over the next 5, 7 years. So move ahead.
Basically, we are in a structural bull run with certain corrections in between. And I
Correct.
think that every dip should be an opportunity to re-enter the market with more money, rather than really looking at points where it's an extreme and you are looking at exiting. More than that mentality, it is buy on dips kind of a market, because given the structural change which India is seeing, based on many factors which we spoke about.
Absolutely. So just to put that thing in perspective, if you look at the journey from 92 to now, markets have seen enough and more corrections for a variety of reasons. And yet we keep creating newer highs. And that's exactly the point that we are talking about. That yes, indeed, we may go through this volatility in the short run for multiple reasons, but from a long-term perspective, India's story looks very structural, and possibly we should see one of the highest wealth creation happening over the next 5, 7, 10 years. That's how I will like to sum it up. If there are any more questions or anything else, happy to take those.
I think there is one question around the US elections. now that Donald Trump has won the US elections, how do the geopolitical things, how do we see the geopolitical things? Do you expect a volatile geopolitical situation arising and how it will impact India and our earnings?
If Trump's first presidency is anything to look at, he is known for coming up with very, very erratic statements every now and then, and that will bring in volatility in the markets. From a business perspective, Trump, even in his first presidency, has been pro India and anti China, which again he has kind of hinted towards that he is clearly looking at uh, putting trade barriers on China, Canada, and Mexico, which augurs very well for India. In fact, Trump's other agenda, even in his first presidency, has been Make in America. Like I mentioned earlier on, a lot of Indian companies today are setting up shops in America, which again should be the beneficiary if Trump proceeds with this whole Make in US thing. And Indian companies who have set up shops over there will definitely stand to benefit from that perspective. So, from a overall basis, I think it's net good for India.
And given, people expected Trump to win, everybody in India was also expecting him to win because there was a perception that he is good for India in the long run.
Correct.
But even given the outcome of Maharashtra elections, I think whatever, sentiments went bad after what happened in June, I
Yeah.
think the Maharashtra elections has brought a renewed sense of confidence back in the central government and even the leadership in the country. So, do you
Correct.
think that this win in Maharashtra will have a lot of impact on many decisions which will happen in center?
I mean, Center didn't, of course, winning Maharashtra election, strengthens them further because the representation in the Rajya Sabha also changes because of this win and so on and so forth. So their ability to push through a lot of agenda increases substantially. So yes, indeed, having this kind of a majority in one of the largest industrial state will strengthen, the hands of the center as well.
One question on your view on investments in gold and oil, given the geopolitical tensions. So, do you think that apart from equity, even gold and oil would be a good investment at this point of time?
So gold has already seen a decent run up. Uh, I mean, from 1800 dollars, it moved up to almost about 2,200, and now I think it's close to about 2,100 or thereabouts. That largely happened because of the uncertainties. Now, with the US elections behind us uh, and the Iran issue also getting resolved largely, only thing that remains is possibly the Russia-Ukraine war. To my mind, I think gold may see stability at the current levels. I don't expect gold to significantly outperform from where it is at this point in time.
Okay. So following up question is what about silver and other metals?
Well, silver and other metals can behave far more differently because they find a lot of applications from an industrial manufacturing perspective as well. So they may behave far more differently.
Some question is that particularly in the portfolio management which you run, how do you select like good companies? You spoke about being bottoms up, right? And from this space of 1600 small and micro cap, picking up 15, 20 good companies. So any particular screener or criteria you follow to pick up good companies?
Yes, indeed. So we have developed a lot of proprietary screeners and filters that we use to, which throws out our working set, so to speak. But a lot of our companies come actually because of our connects in the industry, where ours is more like a private equity approach to investing into public market. And what that means is uh, we look to invest into the management first. So it's extremely important and critical for us, and especially more so because we are focused on doing the small and the micro cap genre of investing. There, to get a comfort on the management's ability to execute and their vision and transparency is extremely important. Once we have that, and once we understand the business reasonably well enough, that gives us the comfort to take long-term investment calls. And we don't do portfolio investing in the sense that, we end up buying 50 companies in the portfolio, hoping that something will do well. It's a very deep conviction bets that we look to do. So we end up investing only in 12 or 15 such businesses where we can understand the business reasonably well enough and have the wherewithal to do a due diligence on the management. And there, then it's a more of a partnership approach. So we end up taking meaningful minority stakes into these companies, and that could range anywhere from 2% to going up to 5-6% of the companies that we are investing in. So we more end up becoming like a partner, and that's where the private equity approach comes about.
Okay, there's one more question. One of the reason of consumption slowdown was impacted due to mass people have been speculative in derivatives. And now since margin and lot sizes have increased, do we see consumption to again pick up in the next quarters? Also, even after government expenditure to rise, would be able to beat H2 of this year with H2 of the previous year? I think some questions around what is the reason for consumption slowdown? And do you think that this will again pick up in the coming quarter?
Well,
Probably
we
the
are,
H.
we are already seeing some green shoots in terms of consumption. So rural consumption has been picking up. And I mean, consumption, the pattern itself is changing. So if you look at the e-commerce sites and their business, they have been doing extremely well. The pain is basically on the traditional old format kind of stores. So the consumption is actually shifting. Again, what earlier used to be the rural consumption is all got mixed up because you have people traveling from the rural areas to urban areas for shopping. So there has been a lot of overlap because of these kind of things. If
I
I
think
look,
I think
sorry,
even e-commerce has really gone deep into the rural areas of India.
correct,
I think almost every single village now Amazon or these
correct,
companies are delivering the
correct, correct,
remotest of places.
correct. So the patterns are changing. The traditional formats are definitely going through a bit of a slowdown and everything else. I think somebody mentioned about the F&O trading activity slowing down, and can this lead into consumption? I hope so, because people are indeed realizing that it's a zero-sum game, putting money into F&Os without any deep understanding, or F&O is largely to be used more as a hedging instrument rather than using it as a avenue to make a quick buck on the market. And SEBI has come up with a lot of reports talking about how investors have been losing money consistently. So yes, I do think that people will possibly take a pause and maybe move back to doing long-term investing.
Right. Okay, so I guess we have answered most of the questions. Thank you so much, Pavanji. We have been very closely working with Pavanji, and a lot of our investors are also invested in equity. And like he said, that they completely focus on working with fundamentally good companies to a large extent, debt-free, and a bottoms-up approach of first studying the business, then studying the management. And when they are completely convinced about a particular business, then it's a sizable investment. And like he said, the track record which their portfolio management services have over the last decade, it's a 32% CAGR. That means if I divide 72 by 32%, 72 by 32, the number of years in which the money doubles, I don't even want to give that number. I think people can, do that themselves. That's the kind of returns which Pavanji's style of investing has been generating over the last 10 years, and we've been fortunate to have been working together. So I guess to just summarize today's webinar, that while valuations do look a little expensive in certain pockets, okay, but like Pavanji very rightly said, that we shouldn't just focus on one thing. It is a combination of growth. Are the corporate earnings expected to grow? Second is a liquidity, which still looks very strong in India. And third is a valuation. So, how do you address this issue on valuation? Is being very selective and being bottoms up. Don't just look at the broad indices and invest. Look at really the P&L and balance sheet of the company, the kind of order book they have, kind of growth prospects they have. So a bottoms up investing will help you, understand valuations better. Liquidity, we said, is already very good. Mutual fund, SIP numbers, and even a lot of inflows coming in. And growth, given that the stability of government, the structural change, which we are seeing right now, push in manufacturing, geopolitical crisis across the globe helping India. Okay, and a lot of these factors. So we expect that the growth is going to remain strong in the next decade also. So we shouldn't be too worried about the short-term dips. In fact, the clear understanding looking at the data is that we are in a buy on dips kind of a market. The structural story still remains. So we shouldn't be really too worried about these dips. Every dip should be used to infuse more money in your portfolio. And the other way, which I always say, is that there is no point timing the market. It is about the number of times you enter the market and the time spent in the market. So systematic investment, investing regularly. So I guess that investing regularly should continue. That'll like give you the rupee cost averaging, and it will ease out all the concerns which you have on valuation and all that, because you are investing at different points in the market, and you are investing for a goal which is 5 years, 8 years, 10 years away. Okay, so you shouldn't be really too worried about timings and these dips. That is like the best way to tide over the volatility. So this was a summary for today's session. Thank you so much, Pavanji, for such an insightful session and actually cutting out the noise and helping investors focus on the data. That is what, I'd say the God lies in the data. So
Thanks, Devin.
thanks
My
for taking
pleasure.
your time on a Wednesday evening. And if you all have any more queries in terms of anything which we spoke today, we've posted our links in the chat. You all can join our community where we post about our educative events. Most of our Wednesday sessions, almost all of our Wednesday sessions are purely educative and a very neutral kind of approach. So we just present data and facts without really being biased about anything. So y'all can join our WhatsApp group, and also the email ID, which I'm sure a lot of y'all have, y'all can write queries. We've got a lot of emails for our previous sessions also. So once again, thank you so much for joining us on every Wednesday and making this family grow. And it motivates us to come up with new sessions every Wednesday. Thank you so much. The email ID is in the chat. Any queries on today's session, please feel free to write us. In case if someone wants to meet Pavanji one-on-one to understand more about their style of investing in small and micro caps and all, then you can again get in touch with anybody from the Finnovate team, and we'll surely take this forward. Thank you so much.
Thank you.